So Kaloyan, with that, all yours.
Thank you, Nicola. You're too kind. Thank you, and I'm really happy to be here in person for a live event again in front of all of you. So today I'm going to talk about what's been happening in the corporate venturing world in very, very recent times. And the key question to ask ourselves would be, will corporate venture capital be up for a reality check? And we're not even halfway through the year, and there's already so much that's happened. I think it's fair to say we've all been pretty shocked by the war in Ukraine. At the same time, we still see supply chain disruptions going on. They're pretty much from the time of the pandemic, and they haven't been resolved yet. At the same time, we have a super cycle of the commodities and central banks trying to taper and hike interest rates in order to fight inflation. And as we're trying to shake off the chains of the pandemic, so to speak, a good part of East Asia is either under a strict lockdown like China or with some severe travel restrictions like Japan. So markets have not remained indifferent to all of this. They have definitely reacted, and the ones that are actively traded have reacted probably in the most pronounced way, as this slide from PitchBook and Morningstar kind of summarizes. It's not really been just the S&P and the Nasdaq correcting severely. It's been most of the important indices around the world. But public markets are not necessarily indicative of what's been happening in the world of venture capital and the world of disruptive innovation. And indeed, if we look at the latest MVCA PitchBook report, the US VC markets still appear to be vibrant in the first quarter, even though the report did hint on an imminent sort of a correction, which they called a healthy recalibration period, possibly coming up. And if we look at our data on corporate venturing, we see similarly that there's still some sort of vibrancy with over 1,500 deals in the first quarter, with at least one corporate in the syndicate, and their total estimated worth was nearly $70 billion. And more importantly, a majority of the corporate investors that had invested in 2021, or 63%, as you can see on this part of the graph here, already returned in Q1 to do at least one deal, which is a very positive statistic. It's a very positive statistic, whether we interpret it as corporates still having enough momentum to invest or still having sufficient dry powder to invest. And the reason why it's important is a lot of the corporates, as Nicola mentioned, are fairly new. Some of them started investing during the pandemic, and that's something that we look at as an indicator that's very important, because there's a great deal of risk implied in this due to the inexperience and the sort of short trajectory that these corporates have had so far. And even the more experienced ones have only been around since 2010, so they have not really seen or really experienced a true sort of market downturn. And a downturn may indeed be in the works. Now, if we look at total dollar value of deals, VC deals and CVC-backed deals, the total VC deals are in the red line above, CVC ones are in the blue line below. There does seem to be a correction going on for Q1, and it seems to be sharper for the entire VC sort of world than for the CVC sort of scene. Now, of course, these data don't capture some sort of details, such as the use of warrants and special clauses in deals at a later stage, so we have to really bear that in mind. But the main point here is that a correction in valuations is already happening. And it's not just deals that we have to consider. We have to consider exits, because irrespective of strategic orientation of corporates, there is nothing strategic about losing money. And the past 2 years, with the pandemic and the accommodative monetary policy, these past 2 years have been a bonanza for exits, not just for corporate investors, for nearly all kinds of investors in the VC space. And in Q1, we saw that sort of momentum was sort of kept. But we have to really ask ourselves, how likely is this to be sustained and to continue? And the short answer to that is probably not very likely. Given that public markets are not very excited at the moment, and M&A markets are also a little troubled. And speaking of M&A markets, this graph is from the latest PitchBook report on the global M&A markets, and they also hint that macroeconomic factors and geopolitical risks and uncertainties are already palpable in the M&A space. Noting also that some banks have withheld funds used for leverage buyouts, and a lot of PE firms have had to turn to private lenders. That was quite an interesting fact I stumbled on. But the point is that global M&A markets are not as excited as they were a year ago. And despite that, we see that funding initiatives backed by corporates are still keeping a steady pace. And this is also true for overall fundraising in the US VC market. So perhaps this doesn't tell the entire story either, and we perhaps have to look at what's been happening sector-wise. And if we look at sectors in public markets, one thing appears to be absolutely certain. Nearly every sector except for energy and utilities seems to have been battered or seems to have corrected. So that's what public markets are discounting at the moment. Now, there's definitely a bullish case to be made about energy, and this is not only in the context of rising commodity prices like oil and gas. This is also in the context of a global energy long-term transition to net zero. So we have seen in our latest report, latest General Energy Council report, that the oil and gas corporate peer group has increased its investments considerably in the past 2 years and in the past year in particular, and this is likely to remain true. But it's not just energy that we talk about when we talk about disruptive innovation. If we think about sectors in terms of the conventional split between cyclical and not so cyclical, if we look at corporate-backed deals in startups and scale-ups from those sectors, in the tech-heavy and in the cyclical ones, we don't see really a slowdown quite yet. And it's essentially the same thing for the not-so-cyclical areas of business with certain caveats here and there. But essentially, there's nothing in the data that is showing up quite yet. So perhaps we have to go a bit beyond that, because we know there are certain things that are not showing up in the data yet. And if we go beyond that, we have to ask ourselves which sectors are likely to be affected by what's been going on in markets, because right now we know that there are fewer companies reaching a unicorn status than just a few months ago. And we know that public markets are not really gung-ho anymore about VC-backed companies that IPO'd. And the SPAC mania, which has provided so many lucrative exits to so many investors in the industry, seems to have subsided for the most part. So considering all that and the main underlying narrative of markets, which is fear of 1970s style stagflation, where you would have little or no growth and high inflation rates. So we really have to ask ourselves, if these fears of market participants were to indeed materialize, how would that affect startups in those sectors, and how would it affect the corporate venturing community? So rather than think about the traditional cyclical, non-cyclical split, it's probably more practical to think of sectors that are less likely to be affected and more likely to be affected. In other words, less or more vulnerable fields, assuming that there would be stagflation and a rising interest rate environment. So in an environment like that, we do believe in our estimates that sectors that are less likely to be affected would include things like healthcare and pharma, although some of their financing models might have to change. Things like energy and raw materials, despite their cyclicality, seem to be in a sort of an up cycle, and then things like real estate and prop tech would have to be favored in a rising interest rate environment. And then among the most vulnerable ones, we would see high speculative tech, consumer discretionary products and services, anything from e-commerce to automobiles to entertainment, and also speculative fintech with all the crypto assets and NFTs. And of course, this is only a speculation, but the greatest risk for corporate venturers is that stagflation could translate into reduced free cash flows for corporates, which could turn into reduced budget for innovation initiatives, and in turn put at risk a lot of corporate VCs. And that is the greatest risk that we must have in mind here, because whether we experience this 1970s sort of stagflation or something milder, there's likely to be challenges, and there's likely to be a huge reality check. So we at GCV try to help you address that risk, firstly with the conferences and events that we put together, so that you could build the right partnerships and find the right networks, and also with the GCV Institute, which could not only help you train and professionalize, but also help you also deliver the key message to key stakeholders like people in the C-suites or key shareholders within your corporate motherships, that they should continue to invest through the cycles, and they should not cut their innovation and their CVC teams. So with that, I conclude my presentation. Thank you very much, and enjoy the rest of the symposium.